Money Radio for a really great future. We're talking real money.
Welcome once again to another exciting episode of Talking Real Confections. Hello, I'm Don McDonald, and in today's episode, we're going to follow up on the great jelly bean debate from a previous podcast when we talked about the jar of jelly beans and the wisdom of crowds, and of course, got off on a tangent about the flavors of jelly beans in the gigantic Costco Jelly Belly jar.
And just to confirm, I am not a jelly bean guy, never have been, never will be. I do have a jelly bean jar in the front of me here, but that's on my stomach. But that's a whole other thing. But I'm not a jelly bean guy.
We get them every once in a while because Deb's family likes jelly beans.
No,
and I don't mind some of the flavors. The problem is the surprise flavors.
Yes, which you're about to unveil what that surprise is, which you compared to, as I'm sure the Costco folks didn't love, Pepto-Bismol.
Well, there's a jalapeno flavored one. Now, that comes as a surprise when you're expecting sweet.
Yeah.
Some people who like sweet like black licorice. I think it's disgusting, but that's just my personal
How about a quick drink of ouzo if they like that? Sure, why not?
Then we have the mystery Pepto-Bismol flavored jelly
Which
bean.
actually is...
I knew it had to be a real flavor, and so I talked to my friend ChatGPT, who informed me that the most likely flavor for the Pepto-Bismol moniker is Jelly Belly's bubblegum.
Ah, that's a long way from Pepto. And by the way, imagine the royalties they would have had to pay to Pepto for that. Would have been expensive.
They make up these weird flavors, and so they sometimes come out tasting a little medicinal. So I think that's part of the problem.
Here's, as a guy who doesn't buy any of them, don't matter to me. I'm good. Give me some chocolate, all about that.
Now, let's pivot to the real show.
No, this is going to be just as sweet as the thing we just mentioned.
Ladies and gentlemen, welcome to another exciting episode of Talking Real Money this time. Today we're going to regale you with the story a gentleman wrote for Inc. magazine.
Can't believe this got published.
All of these publications, these internet publications, have become shill factories. They really have. They become total. CBS News, shill factory. Kiplinger, shill factory. Forbes, shill factory. They're just letting anybody, anywhere, anytime have an opinion about something, and generally it's an opinion that sells you stuff.
How much is it, by the way, to get a piece like this in there, I wonder?
I have no idea. I have no idea.
Curious
Never
to
tried.
know.
Well,
we
this
could find
article
out.
was written by Joseph Drups, the CEO and general partner of Drups Ventures. And the article is entitled, Why I'll Never Save for Retirement and Neither Should You. Huh? No, you don't save for retirement. He says, the standard conventional wisdom is save 10% of your income and invest it in bonds, stocks, and commodities. Well, we don't say commodities. Save up millions, and then when you're 65, retire. That's pretty conventional.
Yep. Well, except for the bond part if you're young. I wouldn't say that either, by the way.
The next sentence is, well, they're 100% wrong. And it's a debunked myth. It's a myth. It is? Really? So what's Joseph's, Mr. Drups' alternative, Tom?
Well, they according to him, don't understand that cash flow is king, and high returns can shave decades off the time you need to retire.
What the heck does that mean?
I'm
going to say, wait, no, this is the podcast. What the hell does that mean?
Exactly. This is so easy. I can't believe you don't know this. He says,
yeah, sure.
Here's how simple this really is. I bought a website for $10,000 and operated it, making $400 a month in cash flow. I grew it to $5,000 a month. Mm-hmm. My net worth was still only $10,000 from the investment. My cash flow was $50,000 a year.
Okay, first off, let's start with the basic fact that he neglects to mention here. That's not building wealth for retirement. That's a job.
No, it's passive income. He bought the website. It just runs. It just runs.
But he runs it. He says operated it. You can't. I'm sorry. I've been in e-commerce. It doesn't just do it by itself. Somebody has to get the inventory, buy the inventory, put the inventory online, fulfill that, promote it. There's cost to promoting it. You don't just grow it to produce $5,000 a month. You have to add money. You don't just take $10,000 and never add another penny and suddenly get your business from $400 a month to $5,000 a month.
Oh, you're
is a lie.
such a nattering
That's
nabob of
a
negativism.
lie. And by the way, he says my net worth was still only $10,000. If you got a business that was worth $10,000 at a $400 cash flow figure,
bingo,
then now you have a business that's worth over $100,000.
Yep.
So your net worth just went up.
Yeah,
Idiot.
he says, here's the part.
Sorry. Did I call him an idiot? Yes,
yeah,
I did. And I meant that.
Routinely says he invests in small business at 3x to 4x earnings, which means a 30% return unleveraged. I can set this up or any investment so all the cash stays in the investment for decades. In that case, my net worth grows, but I can wait decades to get my cash back. I'm actually net negative since I had to give cash for the investment. Now, what he doesn't say here is what they're selling, what they're doing. There's no specifics about all of this other than this is so easy. He calls it passive income, says it right here. I can earn enough passive income to retire in 5 years.
When was the last? This sounds a lot like the old multi-level marketing myth, but I don't think it is. I don't think this is multi-level. But anyone who has ever run a small business knows that it is the polar opposite of passive. It is about as active as it can possibly be. You work harder when you own a small business than you do working for an employer. I'm sorry, but that's a fact, Tom.
Yeah, let's talk about our experience. We've each had several. I was in the Holly Jolly Berry Company for a while. I had a janitorial firm for a while.
What the hell was the Holly thing?
The Holly Company.
When you were a child.
Yeah. I've had radio stations. I've run newspaper. I've run a lot of things. Mm-hmm. And guess what? I looked this up. It's fascinating because he's talking about how easy this all is. Do you know what percentage of businesses last 20 years, small businesses?
It's not very big.
1 out of 5. And by the way, congratulations, 2 of us, because the one we started is fast approaching 20 years. So it'll be, and it will survive 20 years. He doesn't talk about any of the issues, like a lack of market or capital shortage. And by the way, since he's in IT, that's the worst. According to the numbers I could find, only 1 in 4 make it 10 years. So it's not easy. And then he compares it to public market investing and accepting the terrible single-digit returns after inflation, which is actually right. It is single-digit returns after inflation, right? The real return is for stocks is somewhere around 7%. He says, yeah, real estate might look more attractive on paper, but I discovered co-owning a house flipping business is buying yourself a job. Most passive real estate investors end up becoming full-time flippers since it takes a lot of rentals to truly earn a passive income. None of this is passive.
Wait. So is this him? He's now debunking one of the other sources of advice in the FI, in the FIRE movement, which is to buy real estate and get passive income. So he's saying that's not passive income. Owning a small business and selling stuff on the internet is passive? I don't know. What's he selling?
It doesn't get into the specifics. And by the way, if you go back and look at how many podcasts, and maybe they're still out there, but they're not as highly rated, used to be among the most highly rated investing podcasts, they were pitching how to sell stuff on Amazon at all and make big profits. You remember this, and they're buying their way up on the ratings. So there's a whole bunch of stuff we looked into many years ago. He puts it right out there. He's discovered instead of a way to truly build passive, or he discovered that instead of public markets, more quickly income is creating a small business, not through risky startups or complex schemes, but through a systematic approach to buy existing profitable businesses. Now, you got to pay something to buy the business. As Don said, you got to run the business. And here's the other part.
Pay someone else to run the business.
Well, yeah, but it's way hard. Again, my caveat to any of that, I'm not trying to scare anybody away from being an entrepreneur because I've been one all my life and I've loved it. But most of them didn't work out for reasons I never would have expected. How many people knew what the result of COVID was going to be when they got into, and look at it even today, the restaurant industry is still a horrible place to be right now, right? Lots of things went downhill after a result of that.
Well, I looked and I found his Substack. You don't even know what a Substack is, I'm sure.
Yes, I do. I read Larry Swedros there regularly.
He is. He's a Substacker. Anyway, here's his own description of what he does. Drups Investing, a division of Drups Ventures, acquires and scales small brands with long-term potential. The firm specializes in e-commerce, niche manufacturing, and digital-first businesses, transforming underperforming or overlooked companies into efficient, scalable, and high-impact brands. With a portfolio of 11 owned brands and 5,000-plus products across 16 channels, Drups Investing has grown from $0 to $8 million in revenue, all built without outside funding. This model is simple. Operate with excellence, invest with discipline, and scale with soul. Wait, operate, work, invest, put money in something, scale, put more money in something.
Did you say scale with soul?
With soul, yeah.
Okay.
He calls it, this is return on grit. It's all a bunch of stuff. But here's the kicker with Mr. Drups. Who's auditing this stuff? Okay, first, do we know it's and
nobody? He can write whatever he likes.
Let's assume that he's got $8 million in revenue. I'd like to know what percentage of that revenue comes from those businesses. And what percentage comes from
the system?
This could be what the real story is. This could be the rest of the story.
Yeah, he gets into it a little bit. He says, this isn't theoretical. I've executed and structured this strategy over 7 times, not 7 times since 2017, building a portfolio that generates consistent cash flow with minimal time investment. The magic happens when you build a portfolio of 8 to 10 uncorrelated businesses, while traditional portfolios spread investments across thousands of stocks, watering down your returns. You only buy the 8 to 10 to get you 80% of the diversification's benefits. Well, the problem with that is picking those 8, even with publicly traded companies, picking the correct 8 to 10 for long-term. And there's many work that shows that that's hard enough to do, much more to do it on a small business.
It's actually a job to pick the businesses to buy. But here's what I'm talking about. I'm talking about the thing that may be the prime, maybe, I'm guessing, but hey, it sounds like it. This could be one of the primary income generators because there's really little or no cost associated with this, and that is his Fast FI Club, which you can join for a mere $100 per month.
$1,200 a year, and they'll give you the inside secrets to doing all this.
And they'll share with you the inside secrets to doing all this. A membership community where members learn his passive money machine strategy. Does this sound like Hyposaurus? A space to access syndicated deal flow and small business investment opportunities. A system claiming high-return small business investing is a faster path to financial independence and a promise of passive cash flow and accelerated FIRE timeline. See, it's a FIRE thing. But wait, there's more. You can get into the Founders Group if you have $200,000 plus in income and $100,000 plus in capital, and buy into some of the stuff he's buying into. So he's basically using your money to buy stuff.
But you're getting the big growth, right? Once you're in, things rocket.
Who knows?
Up.
This whole thing is about as opaque can be.
Yeah. Okay, but let's go back. First of all, we're not poo-pooing anyone who starts and runs a small business because we've done it.
Nope.
Some have worked and some haven't worked. That's the nature of it. And most, by the way, as we tried to point out, don't work. It's a very difficult to find the right market, to find the money, et cetera. Number 2, and still, even if I believed in what he's writing, I still would be saving money, setting it aside in public markets, even though I'm not making nearly as much money as he is, for the long haul, because you get growth there that's a different tax situation, by the way, than putting it in a business. So I would still be doing that anyway. So I wish him well. I think this is a lot of baloney.
You're a nicer person than
me. I because I think this is this is like investment newsletters where they make the claims, they can make whatever claim they like. they say they're making big money on the investments, but the real money is being made on the newsletter. We've seen this many, many, many times. It's not a news story. So any of you considering all this should be careful. And by the way, the other part of this is, you pointed this out, Dom, when we were talking about this. This is people that do this are impatient. I want to have a lot of money by X. And generally when people are impatient about their money, they make bad decisions and they end up with, that's right, less money. So, by the way, I was out on my walk the other day and guess what I saw?
Drups?
Nope. A holly tree. I'm going back to the Holly Jolly Berry Company starting this December. I'm returning to my roots. I'm going to make big money delivering the holly.
This is Tom. Tom, as a child, cut branches off of holly trees and delivered them to people at Christmas.
I did. It's
did.
Big money. I think I'm all
probably
over it.
the neighbor's holly trees.
Probably true. Well, in this case, it would be. I was trying to figure out, if I sneak out there at night.
Steal them.
I know, whatever.
But the bottom line here, the real bottom line is not that we're not against entrepreneurship. Totally for it. We love it. But I am against people like this who make these incredibly blanket statements that investing is bad and my system is good, because you got to know it is all self-serving. There's a lot of smoke, but there's no heat. And
well, there may be fire. You may get burned if you put $100,000 into this. So
there's a different kind of fire than you were hoping for.
Your cash may go up in smoke. That's good.
It's kind of nice actually to see the fire movement die down a little bit.
The fire has been reduced. Let's put it that way. So it's still a little smoky, but not what it once was.
Not
All
as
right,
scary
let's
as it once was.
go to questions from Hanover, Massachusetts. Richie writes us, hey, Don and Tom, Avantis just came out with a new total market ETF, AVTM. I currently own AVGE in a taxable account. I know AVGE is a fund of funds, but can you explain the difference between AVGE and AVTM and why someone would choose AVTM over AVGE or vice versa, versa.
Again, the key, and we've said this over and over again, compare funds that are pretty much the same or very, very similar. These two funds are in no way, shape, or form similar. AVTM is a 100% U.S. stock fund, not a fund of funds, just a fund.
In large companies, isn't it?
It's total equity. It's like VT.
But it doesn't have the small value tilts.
No, it does not. It's a large cap blend, right? Basically, dead down the center of large cap blend in the style box. It is 91% U.S. and 9% international.
So it is global to an extent,
teeny
small
baby,
extent.
Yeah. And it's
we haven't still talked to somebody, and I will soon, because we're going to be seeing our guys from Avantis and ask them about this fund. I'll be curious to see what they say. What's the purpose of it? Why did they roll this out?
I don't
know.
No clue.
Couldn't tell you.
But AVUV is a fund of funds, and it's global, and AVTM has been
No, you said AVUV. You mean AVGE is a fund of funds.
I'm sorry. AVGE is a fund of funds.
Yeah.
AVTM has been around for a day.
Short. Yeah, sure.
It's brand new, and I'm with Tom. What's its purpose?
Yeah.
I think it exists just to make sure they've got a competing fund for VT or something like that.
Which, as you may know, billions have been pouring into those type of funds. Big money.
You can't compete with VT, by the way.
Let it go. All right. Speaking of Avantis and Dimensional and all those fun-filled fund families, Lisa from
that was a little alliterative.
Lisa from Montrose, Colorado. Do you know the place, Montrose, Colorado?
Montrose is, it's over on the western slope.
Okay.
Yep.
Okay, so stay with me. This is a little long, a little tricky.
I'm with you. I'm listening.
She says, I'm a longtime admirer of Jack Bogle's philosophy, indexing, low fees, and keeping investing simple. I've been giving a lot of thought to your recommendations for Avantis and Dimensional. I was hoping you might share more of your perspective. My primary concern is that both Avantis and Dimensional have expense ratios that are meaningfully higher than traditional cap-weighted index funds. This leads me to a broader question. What exactly constitutes a true index fund? I'll go on with the question, but let's answer this first because this is a key differentiator between the way money's managed at Avantis and Dimensional and an index fund. Yeah. Please explain.
Yeah. An index fund, a true index fund. Now, there are variations on the index theme that have popped up all over the place, like little slivers of indexes that are called indexes. But a true index fund is something that follows a popular index blindly. If a stock moves into the index, the fund buys it. If a stock moves out of the index, the fund sells it. Perfect example is VOO, the Vanguard 500 Index ETF. It is always going to be the S&P 500 within reason. The Vanguard Total Market Index is going to be the total global market as much as they can emulate it, and they do a good job of doing so. It is the whole thing. The good, the bad, the ugly, the growth, the value, all of it. Everything is in that portfolio. This is popular with the Vanguard Bogle purists. But it's not bad. It's just that there may be better ways to invest. Jack Bogle was a brilliant man, but we've talked a lot to Jack. He was also a very stubborn, set in his ways guy as he got older.
That's true.
He was not open to new ideas.
No. We spent a lot of time on that. Doesn't make what he said wrong, by the way. But
no.
Hard.
But I mean, what? For example, an obvious, investment that Jack said was a terrible idea was stocks in other countries.
Yeah, he was not big on that.
He didn't like international.
By the way, when they say true index, it makes it sound independent. There's still someone who put together the index.
Right.
And there's still people that decide on which companies are indexed and which ones are out.
Right. The S&P 500 is actually somebody making a decision.
Exactly.
They're
so to
big
say,
companies, but there are some decisions that go
Yeah, exactly. So she goes on. I recently watched a 2025 Bogleheads presentation by Rick Ferry titled Index Methodology from Evolution to Pollution. In the talk, Ferry argues by the late 1990s, most true index funds had been created and that many products introduced afterwards, such as fundamental indexes, enhanced index, smart beta, smart factor, scientific, are better described as active, packaged as index. He referenced a 2017 conference in which Jack Bogle was asked about the difference between cap-weighted, fundamental weighted, and equal-weighted indexing. Bogle responded, there's nothing like cap-weighted indexing because it delivers the total market return and avoids sector, manager, or style bets. Which is
correct.
That is correct.
He is absolutely right as far as it goes.
And she adds, this is lengthy, as I said, over the long haul, he believed it extremely difficult for alternative index strategies to outperform the total market. Now, all that said, the information that I've seen, the stuff that I've read from lots of sources suggests that's not true. That instead, factors, different parts of the market have provided additional performance rather than being in just an index for a variety of reasons.
And I only have the numbers I have right in front of me are from 1926 to 2023. So I'm missing a couple of years, but we're talking when this is where it gets very confusing for investors because guys like Rick Ferry start talking short term, and Rick is just as hyperbolic as we tend to be, or me anyway. He's now the standard bearer for Bogleisms.
He is,
and we disagree on some things. But you
were going back to the 20s. What do we say?
I'm going back to the numbers, and here's the thing:
1920s, by the way.
The reason we believe that you should tilt a little bit more toward value and toward small cap are these numbers. And these numbers come from some they're part of what is called the capital asset pricing model, the CAPM, that was based on some research by Eugene Fama and Kenneth French. And others have added to that over the years. The data just gets better and better and better. But the average annual returns for small cap value over the past almost 100 years are in the 13+% range per year on
Remember
average.
that number now. That's U.S. too, correct?
Yes, that's just
Okay.
U.S.
U.S.
This is just
small
US.
cap
Because
value stocks.
We
13.
don't have data going back to 26 for international.
No. Only go back to about
But
70 to be very conclusive.
You can insinuate that it might be similar, but we're not going to say it is. So small value, 13+%, almost 14, over almost 100 years. The S&P 500 over that same period, a little under 10% per year.
Sounds like almost 4% a year to me.
That's a 40%, almost 40%
Yeah.
difference in your return. We
Big.
are no longer talking about small, little teeny, but that's assuming you were 100% in small cap value,
Exactly.
which nobody would have been. It would have been too dangerous. So if you had a blended portfolio, small, large, you're probably you would have increased your returns over that entire period by a little over 1%, maybe 2% per year.
Yeah, I think that's fair.
And that's a 10 to 20% increase in returns.
And she adds that she says, given all of this, my concerns with Dimensional and Avantis are higher fees relative to traditional cap-weighted index funds. Performance, she says, claims based on relatively short time periods. Okay, so to go back to the first one, yes.
That was not a short time period, by the way.
No, so I think we can dispense with that argument.
Yes.
That you're looking over a long period of time pretty clearly. And by the way, during that 100 years, there's periods of times where large growth and all these other things do better. It's going to happen. It's happened recently. But in terms of paying more for a fund, and we give you a great example because I believe the all equity Avantis fund is like 0.23, 0.24, 0.25%, right? Versus going and getting VT, for example, the Vanguard Total World, which is 0.5, point something. I've thought it's far less expensive, right? Mm-hmm. So she makes a fair point there. Our reason for investing the other way is that with the returns outweighed it.
I mean, really, the expense difference is less than 0.2%. So if you're getting you have the potential of getting a 1% plus premium, and you pay an extra 0.2% on that, that's an 80% increase over your additional fees. That's an 80% gain over your fees. So to me, it sounds like it's worthwhile. Here's where it's short term that trips people up.
Yep.
This is where the value and small argument runs into trouble, and that's recency bias. Because from 2007 to 2020 plus 2024.
2007 to 2024, is that what you're saying?
Yeah, 24, 25. Large
that's a pretty
growth
lengthy period,
killed value.
Yep.
It did. Small caps didn't do well.
People thought it was all over.
But we also can look back to history and find that in the early 1930s, growth killed value in small. Post-World War II, growth killed value in small. 70s, growth killed value in small. These things happen. I'm sorry, the other way around. Value killed growth in those periods.
Oh, okay.
But it comes and it goes, but the premium has existed for a very long time. And by the way, Fama and French are not the only ones that find that the value premium still exists, and they find it on a global scale. That is Cliff Asness, who is an economist. The folks at the AQR funds have found the same thing. Dimensional, Avantis, even Vanguard has found that there is a value in small premium because it's there. You can't deny it, even if you're an indexer. It's not guaranteed. It can go away for long periods of time. It requires painful patience to pull it off, but it has in the past worked, and that's all we are saying. We're not saying you shouldn't buy indexes. Buy indexes if you want to emulate the market. If your goal is I'm willing to be more patient, I'm willing to take a little more risk, then overweight slightly into value in small. Don't go crazy, just go smart.
is one of the best explanations. Wow, you had your Wheaties today. That's really good and really well put.
Raisin Bran Crunch.
Oh, pardon me. Oh, that's really good. I don't want to have any of that because I'll have a second bowl. That's excellent. So, and that's the reason why we've invested the way we have for 3 decades now, whatever it is, a long time.
And again, we don't want to play the short term.
No,
but if you look at the short term, suddenly value and small seem to be coming back, as has international. So
exactly. But we have no idea what that means.
We just said be there all the time.
Yeah. So, and again, part of this is to get small in value, you have to be more intentional than just owning large growth. Because if you just own the global index, a VT, you mainly own big companies that are growth oriented. That's the case.
Because they're the bulk of the index.
They are. So anyway, and what we're trying to say, there's nothing wrong with either approach. We have our beliefs. We're sticking to them.
Yeah. And by the way, speaking of the Raisin Bran Crunch.
Is it better than the Pepto-Bismol?
No, I thought it was just me. I thought it was just me getting old. You know, when I open a new box and you reach into that damn plastic bags that they have now. It used to be there was an edge you could grab and peel the bag open. Remember those days?
Yeah. Oh, yeah. No, that's all gone.
These new bags are sealed with like super glue.
I know. I think it is you. You're getting old. I know. I have to get scissors now. I cut them open. I
was going to say, I went to AI and said, are the bags harder to open or is it just me? And they said, no, the bags. Yeah. They've come up with new materials and a new sealing technique that seals them all the way to the very dang top. And so you cannot rip them open. You must cut them.
I do that, and then I think, do you want me to eat your product, or would you prefer I don't? I don't think, why are you making this hard on me? So
I can understand, but you know, if I buy something now in the freezer section, and I open, it has a Ziploc thing. It has a zipper seal.
Boom.
Put zipper seals on your dang bags.
Hey, wait. Will that mean I make 30%? No, it's a whole other show.
All right.
Sorry.
Yeah.
It was too easy.
So
rebrand.
So Drups can buy it and increase the cash flow.
Call them right now, would you please?
There are giant, what are they called now? The big companies that buy little companies and venture
conglomerates?
Capital firms. And, they buy companies to increase their
8 to 10 non-correlated companies. Absolutely,
and it's hard. It's hard for them to identify good companies and then to grow them. And sometimes they fail. You know, like Bain Capital and people like that. Anyway,
leaving it at that.
Don't fall for this stuff.
If you want some help, come see us at talkingrealmoney.com. I'll say that.
Just go to talkingrealmoney.com. Click on some buttons. Something will happen, and your life will be better.
Guaranteed. All guarantees are not guaranteed.
Said the word again. All right, let me put into the disclaimer before the disclaimer. Any guarantees presented by Tom are not guarantees.
Not guaranteed.
They are merely, hyperbole.
Wait, there is one. The Holly Jolly Berry Company is back.
That is hyperbole too, because there is no way he's going to go steal his neighbor's Holly.
I'm pretty tempted.
No, you're not.
It's a good business.
You're not
I liked it.
It's a terrible business in March.
Well, no, I didn't say I was doing it now. I said next fall, though.
Yeah. Well, by the time next year gets here, you will have forgotten this conversation completely.
No, by the time next week arrives.
I know, but I was being generous. We got to go. We're way over time.
I apologize.
We have spent way too much time talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.